Hello and welcome to Market Makers. Now, catch me if you can. That's the tagline for Nifty. In this year, Indian markets have, on a relative basis, on an absolute basis, have really managed to outperform. So bulls are back. Are they here to stay? And to take this conversation forward, I have a bull in our studio itself who's always believed in the India story, Hiren Ved of Alchemy. Hiren, fantastic to have you back. Thank you for joining us.
Thank you.
We are outperforming very smartly and very handsomely. Is the outperformance real and is it here to stay? And if yes, why?
Well, it's absolutely real. You've thrown everything at this market for the last 12 months, right? You name the crisis: inflation, interest rates, Ukraine war, oil above $100, supply chain issues, a possible recession in the US, energy crisis in Europe, you name it, and we've thrown it at this markets. And despite the fact that the markets are at the gate of an all-time high, tells you something, right? I mean, you've known some of the finest investors.
I'm speaking to one also right now.
Right? And there are two ways you build a hypothesis on the market. You look at the numbers, you look at the macroeconomics, you look at earnings, and then you say, okay, the market should be here. Or you look at price action and then decide why the markets are where they are, right? So when I look at the breadth of the markets, the fact that every day new companies are making 52-week highs, makes you believe that this is for real, this is very structural, and I think people are again missing the plot by getting too much caught up in the narratives, that the macro narratives around the globe and all the gloomy stuff that they're seeing. I think if the markets were really bothered about those things, they would have already corrected, right? And I think every correction is so short-lived. And my sense is that we are onto something really big in the Indian markets. Even if, forget the price action, even if I were to, let's say, become very factual and talk numbers, right? What was the Nifty pre-COVID? It was 12,000. Where is the Nifty today? We are at 18,000. We are 50% up in 2.5 years, right? What was the Nifty EPS in March 2020? It was 441. What was the Nifty EPS in March 22? Forget future earnings. I'm talking about what is already in the price. That's 741. So 741 on 441 is a 70% growth. But the Nifty is up only 50% in 2.5 years. So I don't see a reason why this market could not be heading towards 21 or 22,000 in the next few months. It could happen very soon, or it could happen in a few months, but to my mind, it is heading there. There is no doubt in my mind.
But Hiren, then why is that every big brokerage, and I'm talking about big foreign and institutional brokerages who have a fine understanding of valuations and the earnings cycle, are of the view that India is a great secular story, but hold on, sit back, markets are trading way above their long-term averages, and if you bought at these long-term averages, you're not going to make money.
I disagree, Nikunj. I think what I have learned is that you need to first understand the circumstances and decide whether market should trade below averages or above averages. It doesn't trade at average. An average is just a statistical number. In my view, when I put all the things together, right, how India is placed today versus the world, how we are starting a new earnings growth cycle in this country, how broad-based the growth is beginning to happen, how manufacturing is reviving in this country, to me it looks like we should trade above averages, right? So there is no case for trading at average, right? That's point number one. Point number two is that I think most analysts, sell-side houses, brokerages get too caught up with the near-term numbers, right? If you look at Q1, yes, we had strong top-line growth because of inflation and everybody took price hikes. But there was a 450 basis point knock on EBITDA margins if you take the financials out, right, on a year-on-year basis. And Q on Q, I think if my memory serves right, it was about 280 basis points of EBITDA margin shrinkage. Now, obviously, all the raw material price hikes have not gone through, right? So people take price hikes slowly and steadily. Plus, you may have some high-cost raw material sitting in your inventory, which will impact you for a quarter or two. My sense is that even if half of what you've lost in EBITDA margins comes back to you in the second half, my sense is people will start upgrading earnings. So I think 2024 Nifty earnings were about 1,000 plus. They've now been cut to 960. I won't be surprised, Nikunj, if at the same time, 6 months down the line, 2 quarters down the line, this number will go back about 1,000.
We started the year on an optimistic note, then came the war and inflation, earnings were brought down, but your view is that second half the earnings would be plowed back again, it could be above 1,000.
So, because already
And we're
commodity...
talking about FY23, we're not talking about FY24.
I'm not even going to 24, right? I think some of that will come back in the second half of 23, some of that will come back next year because you will have a high base of higher raw material cost this year. Next year you will have a favorable base, right, in 24. My point is that people look at quarter to quarter. Can any analyst today, based on Q1 EBITDA margins, has baked in a higher EBITDA margins in 24? No, they will not do it. They will wait for the margins to improve and then slowly they'll take up margins up, by which time the market's already figured it out. Right?
I like to use the word QSQT. We use in Bollywood QSQT, now in markets also quarter se quarter tak.
Yeah, and I don't blame them because I guess that, you know, that's how they are structured to kind of, you know, look at things. I think as investors, we are taught to look at the big picture. We are taught to step back a little bit, not get too flustered about what's happening from quarter to quarter, and look at the big picture. And to me, the big picture and the future looks very bright for India.
If you have to talk about a pattern in markets, they say that history may not repeat itself, but it certainly rhymes. What has happened in the past will certainly happen in the future. It is just that courses remain the same, horses they change.
Yeah.
Where are we in terms of this bull market cycle? Is it still alive and kicking? And a question which I used to ask Rakesh Bhaiya was, if this bull market is indeed a train journey from Churchgate to Borivali, where has this bull market reached?
We're still at marine lines.
Still at marine lines?
Yeah.
You mean to say this train, this bull market still has a long way to go? Why do you feel that?
Nikunj, I think that, you know, there are a couple of structural factors, right? I think the economy has taken a lot of pain in the last few years. Whether it was, you know, the disruption because of demonetization, whether it was the adjustment because of GST. Then we almost had credit markets freeze in India post ILNFS, post 18 months. See, it may not matter to the top 30, 40, 50 companies, but it mattered to the breadth of the economy. Small, medium enterprises, small companies. When you squeeze liquidity out of the system, it matters to them when credit markets become so tough, right? I think, and then you had COVID, you know. So you have taken so much of pain and now it's all in the base. So if you've survived till today as a business, then I think you've built a lot of, to use a health term, you've built a lot of immunity because you've taken so much of, you know, pressure on yourself and you've survived that now you're ready to run, right? Secondly, the credit cycle in India is just starting, right? Bank balance sheets are clean, credit growth can happen. So that's still ahead of us. I think manufacturing went into a 10-year slumber in this country. That is waking up. Now you may call it PLI, you may call it China plus one, you may call it Europe plus one, you may call it whatever. And we are seeing iPhone is being made, then now today Google says they're going to make Pixel in India, right? I think we are going to see a manufacturing renaissance in this country for the next 10 years.
Like what we saw in IT, it's going to happen in manufacturing.
Exactly, right? I mean, we are now getting very serious about defense manufacturing. We are getting serious about semiconductor manufacturing. We are getting serious about all kinds of manufacturing in this country, specialty chemicals, APIs, drugs, pharmaceuticals, right? I think we are likely to see what is going to change in my view is that 18, 19, 20, 21 was all about betting on the big and the strong and betting on consolidation.
So if you bought into an HDFC bank or a Kotak bank, you made money. If you bought into an Infosys ahead of midcap IT, you made money. If you bought an HUL ahead of, let's say,
generally, right? Generally speaking, the theme has been that the big are getting bigger, the strong are getting stronger, the organized are taking market share away from the unorganized, and that trend definitely has been there, and investors have played that trend. But in my view, if you look at the next 5, 7, 10 years, yes, the big will continue to get bigger, but I think there is a second trend which is starting, which is the survivors, the smaller companies, the manufacturing companies, right? They are likely to now grow and sprint. And therefore, you look at the price action of the market, the breadth of the market has improved. That is telling you something. Why are small and mid caps outperforming the large caps, right? So I think that story is well and truly discovered, betting on the leaders of yesterday and today. The time has come to bet on the leaders of tomorrow.
But right? Even in a tough macro environment, one thing is real, that it is not QE, it is going to be QT.
Yes.
Inflation, whether it is 7% or 5%, inflation is back and is here to stay.
Yeah.
And liquidity will be less.
Yes.
Whether it is because of RBI or because of global factors.
Yes.
Historically, it's been observed that in a tightening liquidity environment, small and mid-cap stocks generally, they fare poorly.
You're right, Nikunj, but what is different this time is that the corporate sector is deleveraged. Okay. QT or sucking away liquidity really plays in two ways. One is that availability of credit to the wider sector becomes a problem. And secondly, it also dampens demand and sentiment to some extent, right? Now, I'm not sure whether what we think as QT will run its full course. Okay. It never has. It did not even after the 2008-9 crisis. They pulled back liquidity a little bit and then they stopped. I think pretty much same thing is going to happen. We talk about QT. What has UK done, right? They've capped energy prices. When you cap energy prices, what is that? To me, that's QE. Because that's a £150 billion stimulus. Yeah. If today somebody was to tell me, you know, I'm going to cap your electricity bill at 2,000 rupees or 5,000 rupees, what does it mean? It means QE to me, right? Because I won't have to pay for energy prices, and I will save that money and I'll spend that money somewhere else. So I think the problem or the structure of the world is such that every time there is a crisis, in some form or the other, the government either does a fiscal transfer or does a monetary easing. Now, because inflation is at our back, you can't do monetary easing. But once inflation peaks and growth slows, I don't think that QT will happen. But anyway, let's not get into that macro discussion. My view is that higher rates in India, unless they go abnormally high, are not going to matter either to demand or to the corporate sector, because the corporate sector is already deleveraged. Yeah. We are not leveraged anymore. We were leveraged 5, 7, 10 years ago when the NPL problems was at its peak. We were coming off a massive leverage cycle from 2006-7 right up to 2010-11. And then we had 10 years of deleveraging, right? So I don't think QT is really going to matter. I think balance sheets are strong, cash flows are strong. I mean, you look at the data. The top 500 companies in this country have generated 1,85,000 crores of free cash flow during the 2 years of COVID,
the
2021 and
Tata Group is projected to have a cash flow of nearly 2 lakh crore in FY23, which is an outstanding number.
And the second thing, Nikunj, is that today, if you have a reasonable business idea, there is enough capital to back it, right? Which was not the case earlier. We now have a very well-developed startup ecosystem, venture capital, private equity, there's so much of money waiting on the sidelines to be poured, right? And I think now even in the new age, corrections, valuation corrections have happened. So I think the cycles will play for itself. But I don't know, I just feel that, we're going to have a big growth cycle in this country. We are so sweetly poised. Yes, the only risk is that we tend to believe this too early, so I hope we don't make
And
some
markets,
mistakes.
according to you, are not pricing in this scenario.
No,
Okay.
I
Now
don't think so. I don't think that they are pricing in a long-term structural earnings growth story.
Which is
when I
important.
read a lot of strategy reports and earnings reports, and people are still, we are cutting.
Saag grapes. Saag grapes.
Saag grapes. Absolutely.
I'll throw data at you, and that in a sense it's an amazing difference between the banking index and the IT index. Nifty is flat for this year. The banking index is up 15% and the IT index is down 26%.
Yes.
So the difference between IT and banks is almost 40%.
Yes.
Will IT catch up in terms of a comeback, or will banks come down?
See, I think, Nikunj, we can't, obviously we can slice the data and take whatever endpoint and look at this, right? I think the story of the recovery of this market from the COVID lows has been sector rotation, right? I could complain that banks didn't do well for 2 years, right? And hopefully now the catch-up is happening. And I think the catch-up will happen. I think financials in general should do very well. I think tech got a massive tailwind, right? Both from digitization, but they also had 200-300 basis point EBITDA margin tailwinds because they didn't spend on travel, they didn't spend on events, and they were doing all the work offshore, and they didn't spend on infrastructure and stuff like that, right? Some of that will go away. We are seeing that in the margins, right? And then some of it, in my view, is fear.
In tech.
In tech is fear that a recession will happen and tech spending will slow down. And therefore, I think that in anticipation of that, the tech index is corrected.
But that's historical data, isn't it? Every time there is a macro headwind in the developed markets, and this time we are looking at not contraction but recession in Europe, which is more than 20% of the business for IT companies, they will feel the heat. Europe needs heat, and the heat will be felt by Indian IT companies.
You know what has been very interesting is that every time any geography goes through a lot of pain, yes, maybe initially spending is cut back, but outsourcing then grows double the speed after that, because then people want to structurally cut costs, right? My sense is that the labor problems or the labor shortages or the cost of labor problem that we are seeing in the US and European countries is only going to exacerbate, because you've made people lazy by giving them dollars. Nobody wants to work, right? So what happens? Okay, fine, there is a slowdown, there is maybe a mild recession, and then when the economy needs to pick up, where is the skilled labor available, right? So if you look at the graph from 2008-9 till 2021, India's market share in IT offshoring has gone from 6% to 15%.
And TCS is now the biggest IT service company in the world. It's higher than Accenture.
Exactly. And now, will it go from 15 to 20 or 25? I think so. So I am okay if tech stocks don't deliver for the next 2 quarters. Who cares? I don't buy for 2 quarters. I buy for multiple years. You've never made big money by thinking about 6 months and 1 year.
So what are you buying for multiple years? Spill the beans.
No, I think we continue to be invested in tech.
Okay.
We were very clear, as I've said many times on this show, that in IT services, we have moved from the large caps to the specialized companies, which structurally are growing faster.
One of them is Tata Elxsi.
Obviously, Tata Elxsi, KPIT, Persistent Systems, the likes of those. I'm sorry, I'm taking these names, so these are all disclaimers. We own it in our portfolios. But I think that the big companies will see a slowdown in growth, and which is okay. They will return shareholders more dividends and buybacks. That's how the returns are going to come from the large cap. Structurally, it's the smaller, specialized companies in software which will grow. But keep that aside. That's something that we are playing long term. I think to play the next few years, we are doing a lot in manufacturing, right? So, again, from auto ancillaries to specialty chemicals to companies which are in the supply chain for electronic manufacturing to EVs, you name it. And we are there, right? I think, as I said, I'm very bullish on manufacturing. So you choose. Manufacturing is a very wide term. You could do manufacturing.
So what are long haul bets in manufacturing? Because manufacturing, like you said, defense is manufacturing, textile is manufacturing, engineering is manufacturing. So where are you picking your spots and where are you investing?
So I'll tell you, basically, obviously specialty chemicals is one area.
That comes in manufacturing.
Yeah, because it's manufacturing at the end of the day, right? It's China plus one.
It's a product manufacturing.
It's chemical manufacturing. It's chemical manufacturing. And India has a strong base in chemical manufacturing. So I'll put specialty chemicals, APIs in one bucket, right? Second
which would include, let's say, a name like DVs, which you owned for years.
DVs we've owned for years. Even Syngene now, which apart from contract research is also getting into contract manufacturing in biologics and stuff like that, right? That's been India's traditional strength. Then I think what has happened and what will happen is that a lot of the companies which were traditionally in engineering or auto ancillaries will also do a little bit of EVs, but they will also do something for defense, they will do something for cap goods. So I think this entire engineering basket, right?
Like a migration of Bharat Wood. It was an auto ancillary, now it's defense and engineering company.
Exactly. So from autos you do non-auto. So you, let's say, for example, Sundaram Fasteners, which we own, right? I'm again just giving an example, right? I mean, they were purely auto and very largely in heavy commercial vehicles. Now they're doing heavy commercial vehicles, but they're also large business in non-auto. They do fasteners for windmills, for example, right? And that's a huge business, right? They've already started doing parts for electric vehicle manufacturers, right? What is core? They have engineering skills, they have manufacturing skills. They will use that skills in defense. They will use the skill wherever there is growth in electric vehicles. They might use the skill in renewable energy. I think the canvas is very wide, right? So we've done everything in manufacturing from renewable energy to auto ancillaries, to specialty chemicals, to defense, to pure engineering companies, to even companies like mining, companies like AIA Engineering, which make grinding media, which goes into cement and copper and all the metals and stuff like that. So pick good manufacturers, whether they be in textiles, in specialty chemicals, in engineering, in defense, which have shown that they have good capabilities in manufacturing, margins are good, return on capital is good, and good strong balance sheets. And I think just hold them for the next 5, 7, 10 years, you'll make a lot of money.
So what kind of allocation do you propose for next 3 to 5 years? How much in finance, how much in consumer, how much in manufacturing?
Unfortunately, we don't think top down like that, right? I mean, we look at bottom up opportunities, but I would certainly say it is time to go overweight on manufacturing, right? Yes, financials, yes, tech, all of that is good. One other area which I didn't touch upon in all of this, and which is a trend that we are seeing, is to go after everything that is premiumizing in consumption, right? So I think incomes...
Give me an example.
Titan.
Okay.
Or, we've bet on a small luxury retailer called Ethos, right? People didn't think that people would buy luxury watches, but I think there'll be a boom in luxury spending in this country. Or we've loved the liquor stocks, for example, right? I think United Spirits, it's a great premiumization story, right? I think everywhere where you think premiumization as a trend will happen, QSRs, restaurants, right? I think people will dine out, because we are now seeing, and we've seen that every time per capita income goes above $2,000, you see a hockey stick. Look at housing, luxury housing, people are buying real estate left, right, and center. So I think that's another big area which I think will grow, which is discretionary consumption at the higher end, and wherever premiumization trends are there, I think that's where we want to bet.
So we've been very stock specific, but we covered a lot, and the fact that the bull market has only reached marine lines right now is a clear indication of the level of bullishness you have. Fantastic to have you back on Market Makers, and
thank you so much
more of
Thanks,
going
Nikunj.
forward. That's it on this edition of Market Makers. Thank you for tuning in, and thank you for watching the show.